A lot of people I'm speaking to are looking to leave the UK and move to places like Dubai, Qatar, or Oman. To properly leave the UK and not be subject to UK taxes, you need to ensure that you're a non-UK resident under the Statutory Residence Test. See the comments for my video on the SRT and how to make sure you meet this test. But what happens once you've left the UK? Do you lose access to certain tax reliefs? While the UK doesn't have an exit tax like some countries, leaving the UK does mean that you're no longer entitled to valuable tax reliefs and exemptions, which is why it's crucial to speak to a tax advisor and plan your exit properly so that you make the most of any reliefs before you leave. So what do you need to consider? If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor. I trained in the private client teams at one of the big four firms, and I now work with individuals and business owners on complex tax matters, including inheritance tax, business restructuring, and increasingly tax residence and leaving the UK. In this video, I'll break down what UK tax reliefs you might lose when leaving the UK and how you can plan ahead. Let's get into it. When you become non-UK resident, the standard position is that you lose access to the £12,570 personal allowance in the UK. That means that if you have UK income like bank interest or rental income from residential property, you'll be paying UK tax on the full amount. Certain individuals do get to keep the personal allowance. If you're a British citizen, you retain it, even if you're non-resident. And nationals of certain other countries can also keep it under the double tax treaty with their country in the UK. Business asset disposal relief, which reduces the rate of capital gains tax on disposals of qualifying business assets to 14%, is generally only available to UK residents. Of course, if you leave the UK, you might end up paying zero CGT on the sale of a trading business, but you do need to watch out for the temporary non-residence rules. If these apply, you'll still be subject to UK tax at the highest rates. Private residence relief, which can exempt your main home from UK CGT, is only available to non-residents if you meet the 90-day occupancy rule. Depending on your circumstances, meeting that rule could cause you to become UK resident again under the SRT. Remember, UK property is always within the UK CGT net under the non-resident CGT rules. So if you're planning to move, it's worth discussing your options for your home before you leave. And if you do sell a UK property, you must report the sale to HMRC and pay any tax within 60 days. The Enterprise Investment Scheme, EIS, and Seed Enterprise Investment Scheme, SEIS, are only available to UK residents. Non-residents cannot claim income tax reliefs or CGT deferrals on new EIS or SEIS investments. And if you've already claimed EIS or SEIS relief and then leave the UK within 3 years, that relief can be clawed back and taxed. And if you've used EIS to defer a capital gain, becoming non-resident can trigger that deferred gain, become immediately taxable. If you still own and control a UK business after leaving, it could end up being treated as tax resident abroad. If your company is incorporated in the UK, it will always be UK resident. But if you leave and control that company from abroad, it might also become resident in your new country of residence. That can mean paying tax in 2 jurisdictions or relying on a double tax treaty for relief. Relief is often available, but it does add complexity. Operating your UK company from abroad could also create a taxable presence known as a permanent establishment in your new country, which could lead to foreign tax liabilities. And if your company becomes non-resident or has a foreign permanent establishment, it could lose access to certain UK R&D credits. Any dividends that you take from the company will likely be free from UK tax, subject to temporary non-residence rules, but they could be taxed in your new country depending on where you move. So while there may not be an official exit tax, leaving the UK can mean losing access to certain valuable reliefs. And the impact can be substantial, especially for entrepreneurs, investors, and high net worth individuals. Effective planning, such as restructuring or making disposals before departure, can reduce the impact, but you need to act before you leave. We work with clients to help them understand the full picture when ceasing UK residence so that they stay compliant and tax efficient and don't pay more than they need to. If you're thinking of making the move, reach out or speak to your advisor sooner rather than later. Hope you found this video useful, and if you did, don't forget to like and subscribe for more tax planning insights just like this one. See you in the next video.